Hey, this is Stefan Belholm, Director at Prudent Wealth Strategies, and in this tutorial, I'm going to be going over the three forms of tax structures that we use in our practice to help investors legally avoid taxes. You have enterprise contracts, trust, and charitable agreements. Now, let's start with enterprise contracts. Now, these are typically only used in the mergers and acquisitions world, but they can also be used in the sale or exchange of any capital asset, from a business to real property to cryptocurrency. It really doesn't matter. Now, in order to use this tax structure, the IRS does require that you have a specific business or investment purpose for the sales proceeds, because these transactions are specifically designed to help investors exit from one business or investment to another on a tax advantage basis. And this is exactly what AT&T used when they did a $43 billion transaction and paid zero taxes. So after you exit your investment, if your goal is to reinvest the proceeds into another business or real estate venture or to generate income, this may be the type of structure that you want to use. You get to legally avoid a whole bunch of money in taxes, you have more options, less restrictions, and you have access to your money. It's a no-brainer. You don't have to go into real estate. There's no 45-day identification period or 180-day exchange period. So if you're thinking about doing a 1031 exchange, you'd be crazy not to consider this much more efficient alternative. Now let's talk about trust. A lot of people get intimidated when they hear the word trust. They think of complexities, mountains of paperwork, tax filings, expensive attorneys, but setting up a trust is not as complicated as you may think, and they're a very useful tool when it comes to legally avoiding taxes, because you can exempt a portion or all of your income within the trust. So little to no taxable income at all. You can also qualify for deductions and tax credits that you can utilize immediately on your taxes. And this is a long-term strategy. It's not something that you want to implement for a one-time transaction. So if you intend on selling more assets or earning more income down the road, this is definitely something that you want to consider. Additionally, properly structured trusts offer the greatest amount of asset protection and invisibility. So you're basically immune from any lawsuits or liability. Now, this is not to say that someone can't sue you, they can, but if they know they can't get any money from you, they'll probably stop dead in their tracks. Now, there's a myriad of ways to organize and set up trusts. They can be very flexible. So as long as it aligns with your overall goals, you should definitely evaluate the benefit of a properly structured trust. Lastly, we have charitable agreements. Now, there are a lot of great charities out there. Red Cross, St. Jude's, United Way, or maybe your local food pantry or soup kitchen. Now, whether you're charitably inclined or not, these phenomenal tax structures are completely off the radar of most investors. Why? Well, a lot of people, when they think of a charity, they have this whole idea that, a charity is just giving your money away for a tax deduction. And that's kind of true, right? If you give cash or a cash equivalent donation to a charity, you get a write-off in exchange. It's pretty simple. But unless you really love that charity, you probably wouldn't want to give all your money away just for a tax write-off, right? You get the deduction, but you don't have your money. But when it comes to reducing or avoiding huge taxes, what most people don't know is that you can enter into a partnership with a charity or a charitable foundation when you liquidate or sell your assets. What does that mean? Well, when you're selling your business or that property or your Bitcoin or you're cashing out an IRA, whatever it is, as long as you're doing it through a charity, you get to partake in the same tax benefits as a 501c3. And you have control and access to the money, so you're not just giving it away. Now, some of the money does have to go to the charity, but it's way less than what you give to Uncle Sam. But here's the kicker. Charities are allowed to pay interest. And if your charitable agreement pays out interest, you can actually get back all of your money over time and then some. So you get to sell your asset more tax efficiently, you get the entire value of your asset back, and you get to support a charitable cause at the same time. It's a win-win-win. Who could ask for more? And it doesn't necessarily have to be a big national charity. You can do this and have an impact on a local charity or foundation, maybe a synagogue or a church or local college or parochial school. It's really up to you. So that's it. Now you know a little bit more about the different types of tax structures The next step is to see which one will work best for you in your situation. So that's it. See you in the next training. And remember, Uncle Sam is not your uncle.